Good afternoon. Welcome to the TheoTrade Afternoon video. I'm Blake Young. Today is May 2nd, 2024, and we're going to talk about the Fed is telling us go to non-cyclical stocks. Now, you may not have heard that. You may not have seen it directly, but we did see it in the response from the market to the Fed and the expectations of the Fed going forward. To start with, we can look at the S&P 500. The S&P 500 yesterday tried to rally on the Fed. You can see that in that candle right through there yesterday. The S&P 500 tried to rally on the Fed, jumped up, but settled down and closed down. Today we gapped up, tried to push bullish again, but we created lower highs and lower lows. So we're still in 4 days of lower highs and lower lows as far as the S&P 500 goes, despite the rally late into today and the gap up that we already experienced. So what is the market really saying? What is the market looking at in conjunction with these last few days after absorbing the data from the Fed and knowing that tomorrow is non-farm payroll? Well, to start, we've got to talk about interest rates. And we could absolutely start with the ZQ and calculate every single month what the probabilities are based off the rates of the Fed funds futures and the current rate and determine what the probabilities of each one are. But it is a little bit easier just to use the CME Fed Watch tool. And the CME Fed Watch tool, if we look out to June, has basically a 0.14% probability of rate cut. We're really leaving rates unchanged is what we're anticipating even for June. They've left them unchanged. They said there would be no rate cuts. They've repeatedly said no rate cuts, no rate cuts, and the market keeps trying to price in rate cuts. They've given no indication they're going to give the rate cuts. They're going to continue to watch. They've just said that we're not going to hike rates. That does not mean that we're going to cut rates. Market is pricing at about a 14% chance of a cut. Now, if we look out all the way to December, if we try to plan out to the end of the year, we are currently at this level, so there's only a 13% probability that they're going to leave rates unchanged out by December. And as we can see, we have 1, 2, 3, 4 rate cuts with 3% or more probability. I wouldn't worry about that 0.2%. But if we add these together, we have a standard deviation. Reality is we have about an 87% probability of at least one rate cut and a 33% chance of a second rate cut. So it's no signs of what I would consider the potential of rate cuts until maybe the end of the year, and that would only be a quarter point. That tells us that our interest rates, our mortgage rates, and most importantly, our credit card rates are going to remain near multi-year highs. In fact, we're talking about highest levels we've seen in 23 years. So if we know that interest rates are not coming down, we're going to hold them above 5% or near 5%, and we know that credit cards can be 20-25% higher than the Fed rate, and mortgages are 2 to 3% higher than the Fed rate, we know that they're holding up in that very high level, and the cost to borrow are going to remain pretty high. Well, we can see as well the delinquency rate on credit cards remained at a 13-year high. We're going to get the next credit card rate reporting here in about 3 weeks, and the quarterly report is expected to rise. We could see 3.1, we could see 3.5. I'm actually expecting us to get about 4% on the next delinquency report, just based off what we've seen in the automotive industry. And so if credit cards are already defaulting and people are already paying high interest rates, their behavior and their spending is going to shift away, as it already is, away from the stuff that we don't need and just want into the stuff we have to have and don't want and need. And so this seems to be a good time to be looking closer at consumer discretionary versus consumer staples. If we look at consumer staples, XLP, the sector ETF, you can already see that the market responded that way today. Yesterday we dropped down, we saw that weakness there, but today we followed through and XLP climbed and closed up higher. In fact, we gained about 1% today on XLP after all was said and done. Much better than what the S&P 500 did, closing relatively flat. And so XLP has also done really well. This is just for this year, 2024. And you can see in these first 4 months, you can see that we've gained about 5%, 5.44%. Annualized, that's going to give you a value upwards of maybe 10%, 12% for the year. And as high as 15%, 15.5% if we continue at this rate. So it's doing fairly well in a market that is struggling to decide which way it wants to go. If you take a look at XLY, the consumer discretionary stock, you can see it hasn't performed well and is actually net down for the year. If we go from the opening day of the year and we look at the current price, we already see that being priced in. And yes, today was up today, but overall we're down for the year. And even though it's up, we certainly haven't taken out the previous day's high. And so I'm looking for the continuation of this pattern. I'm looking for consumer discretionary, those things that we don't need but want, to struggle. And I'm looking for those things that are needs to continue to go higher. If yields stay high, if borrowing costs remain high, if money remains expensive, then we are going to see the support or the backing behind the stuff that we need, and consumer staples is going to win the day. To do this next part, I'm going to go out to the year, and I'm going to start with Costco. I've talked about Costco quite a bit. I like Costco. I think there's still a lot of upside to it. I think this pullback after their earnings has stabilized, and they actually did fairly well with earnings, and they have a tendency to do very well and sustain things even during a pullback economically. So as we look at this stability that is going in here, these higher lows, a break above 734 could and should be able to fill the gap and get all the way back up to 787. So we could be looking at 40, 50 points higher in Costco over the next 3 to 6 months. And you can see the trend is extremely strong for the year and pushing higher. But I'm not going to spend too much time on Costco. We've also talked about Walmart. I do like Walmart as a trade to sell put premium against Walmart and collect some things while we're trying to push this higher. We've talked about selling that 59 over the last couple of weeks, and I'm sticking with that. I still think it looks pretty good, and you can still get about 2.5% to 3% by selling puts at the money. But the ones I want to throw in here today are Procter & Gamble and Colgate, as we have a tendency to want to still shower and brush our teeth and have stuff like clean clothes. And so as we watch this, I think Procter & Gamble and Colgate, even though they're barely breaking through the highs here on Procter & Gamble, I do think the opportunity is in this pullback, recovery after earnings and the breakout. In addition to that, as we're pushing up to these highs and we're looking at the move pushing to as a breakout, we could see Procter & Gamble not just run the distance from 156 to 163, which is going to give you about a 7-point move. But that 7-point move is a 5% climb, and in addition to that, Procter & Gamble is a high dividend stock, or what we'd consider a good dividend stock, at 2.5%. And so I wouldn't necessarily wait for the pullback or selling puts on this. I like the idea of buying into this, and the cost of the options is very inexpensive. Let me show you what this looks like. If we look at the current implied volatility percentage, we're at 16%. And you can look over here and see 12, 13, 13, 14. Implied volatility is extremely low on Procter & Gamble. And that's telling us that at 16% on low cost in the implied volatility tells us it is actually fairly cheap just to buy a call. And maybe an in-out spread or maybe a diagonal. But Procter & Gamble looks really quite good as far as the cost in a call option. Now Colgate has already run quite a bit, but you can see the same kind of pattern that I'm looking at with PG is here in CL, and that we already broke out, and we were look for the move from 86 to 90, which is about a $4 move, and we've gone about $3 of that as of today. So there's not a lot more to go up to the top. I do see these rising resistance levels that should match up to about 94. So Colgate might be worth a pullback and then sell puts, or pull back and then buy into the options. The options are super cheap on Procter & Gamble. And when we're looking at Colgate, Colgate is a little more expensive at the 35th percentile. So maybe letting it fade back, letting it retest 90, 50, or 91 for the opportunity to buy Colgate. And I do think that will probably sustain this continued trend that it has been in since October of last year. Now, October was the peak of interest rates, and Colgate found its base, and we've just kept on climbing ever since then. Now, if we're going to assume that we're going to spend money on the needs and not the unnecessary things like Starbucks, you can see Starbucks already responded to its earnings with a major gap down. I would be looking for any lower high in this gap area. If Starbucks bounces up and gets to 80 and it rolls over, I'd look to short Starbucks, buy long puts, sell call verticals to benefit from the next move down in Starbucks. I think this earnings miss and the huge gap down, the punitive behavior in the market towards Starbucks is not done. And I think we still have some downside as we watch the market continue to look for safety and away from the things we don't need. Now, we could do something like that and say Starbucks is a little bit more expensive. And I normally wouldn't look for something like Domino's for a short, but if we get back through 500, then I do think we can drop back down to 470. And I don't think Domino's is like Starbucks. It's a non-necessity, but it also is a substitute. Instead of going out to dinner at some of the fancier restaurants, we might be going to Domino's instead. If we're looking at things that we might not spend money on, what about the idea of selling gambling stocks or MGM? MGM had a big gap up on its earnings and has already faded down. So a gap up, close down is what I consider an exhaustion gap. We still have some downside to fill the gap down to 40, which isn't a lot of room. But after the volatility comes out of this from the earnings, then we should see a continuation lower. We've defined the top. It could be an opportunity to sell call premium. But if the volatility crushes out much quicker, we're already at a key level, and a move back to fill the gap and a trade below 39 could see another $5 move, which means I'm looking for a 15% decline in MGM. And you can see on their earnings, not only was it a lot lower than previous, it was the gap up by beating analyst expectations, but it was lower than previous, and I think you will fill that gap right to 39.75. Las Vegas Sands is another one we could look at. Las Vegas Sands is a little bit trickier as far as just treating it like a gambling stock. It reacted to MGM and gapped up, but it already had earnings. And you can see it was knocked down from 50 all the way down to 46. So I'm looking at these highs in Las Vegas Sands as an opportunity to potentially sell into Las Vegas Sands some premium. But the problem is the calls and the puts are very cheap. And so therefore, it might be better to just buy a long put. It's in the 18th percentile as far as Las Vegas Sands is concerned. And so the downside might be better captured with a long put in Las Vegas Sands and a short call vertical on MGM. And the short call vertical on MGM, the implied volatility is still at 43%. If we look at something like 30 days out, we'll take May 31st and sell the premium up there at a delta of 38. A short vertical would pay you 38 cents for a dollar wide, which means you're getting paid 38 cents and risking 62 cents. So it's better than 50% return on risk with a 60-some% probability of success. So any of the stocks, if you look at MarketWatch, any of the stocks in the consumer discretionary might be worth selling highs, bounces and selling the highs. Airbnb, for example, or Marriott. If we see money moving away from discretionary spending into non-discretionary spending, the stuff we need, then these ones might give you opportunities to fade those lower highs in this current downtrend. Well, that's going to do it for me today. Thanks for watching. Join us again tomorrow morning at our live Theo Trade Live with Brandon and I. Otherwise, have a fantastic week, and I'll see you again next week.